Internal rate of return, often simply referred to as IRR, is the discount rate at which the net present value of an investment becomes zero. In other words, IRR is the discount rate which equates the present value of the future cash flows of an investment with the initial investment. It is one of the several measures used for investment appraisals. By relating this to NPV, firstly we should know a bit of details about NPV, that is net present value. NPV refers to the difference between present value of the cash flow, that is cost and revenue. If the NPV is more than 0, the project is profitable, whereas if NPV is lesser than 0, project is not profitable. Accordingly, at what rate NPV would become 0? That value is called as IRR. For example, assume a scenario where a company wanted to decide to take up a project which has the cost of $3 lakhs. This project lasts for 3 years and expected to generate $1,50,000 of revenue year on year for 3 years from the year 1 where the first phase of the project is completed. Besides, company will become eligible for an incentive of $10,000 if the project is completed within scheduled time. Using IRR, company can determine whether the project must be taken up or choose the available alternative options which would return about 10%. So let us calculate IRR for this scenario. Given present value of the cost is $3 lakhs, which is one-time investment, and present value of the future cash flow can be calculated using the formula FV by 1 plus R to the power of N, where FV is the future value, R is the discount rate, and N is year. Now at what rate of R will make the PV of revenue equal to $3 lakhs, which will make NPV is equal to 0. Accordingly, the value of R which makes NPV 0 is 24.54%. So this we can understand by looking at the next screen. However, from a purely financial standpoint, company can take up the project since this generates 24.54% return for the company, which much higher than 10% return available from other investments. A general rule of thumb is that the IRR value cannot be derived analytically. Instead, IRR must be found by using mathematical trial and error to derive the appropriate rate. However, most business calculators and spreadsheet program will automatically perform this action. Let us understand this calculation in the next screen. Okay, considering the problem we have, let us look at IRR calculations. So as we know, 3 lakhs is the present value of the cost, and we have yearly revenue what we are getting, that is $1,50,000 each year for 3 years and 10,000 incentive if everything works as per the schedule. So what we need to find now? So we need to find the present values of all these values and we need to sum those up, and that present values will be found based on the rate of return. So what is the formula we should use? The formula is PV is equal to FV divided by 1 plus R to the power of N. Then what is PV, what is FV, what is R, and what is N? So let us look at that. Let us understand that. So PV is present value, FV is future value, and R is rate of return, where the value of R we should find here, which would make the PV sum of all these PVs is equal to 3 lakhs, which is equal to the cost, so that NPV will become 0. So at what rate it would become 0 is the one which you need to find out. So let us see. Let us consider as 10% as the initial R. So let me put 10% here for sake of our calculation starting with. And then based on the formula what we have, let us calculate the PV for each year what we have here. 1, 2, 3 years. So accordingly we get the value. Now let us look at these formulas. We have D6 divided by 1 plus F6. F6 is this R and N is 1. Power of 1 is 1, so it is straight away represented like this. So similarly, if you look at this, 2 times I multiplied to the power of N. For 3 years I have multiplied by 3 times. So it is power of 3, which I get a values like this. Similarly, for 10,000 which comes after 3 years, we have got this value. So now at the rate 10%, we are getting 3,80,000. So is that okay? It is not serving our purpose to find IRR. 10% is not the IRR we are looking at. Now let us use the capability of Excel sheet, that is what if analysis, which we have a goal seek there. So let us do the goal seek of this particular cell E10 for 3 lakhs by changing the rate R. So what is that value would we get by doing that? So that is, we are seeing that is 24.54%. So the rate, at the rate 24.54%, the sum of PVs will become 3 lakhs, which means 24.54% can be called as an IRR, that is internal rate of return. So that's about calculating IRR. Thank you so much for listening to this.